In this video, I'm going to talk about some outdated money rules that you need to stop following. It's often taught that paying off your debt is the most important financial goal when you're trying to get ahead and become financially stable. But there's one problem. It's hard to pay down debt, especially a large amount of debt, if you don't have a lot of money. And I used to live by this advice for many years, and I would become frustrated when I could only make the minimum amount of payment from my debt and I wasn't able to get ahead. Now, we all know if you're only able to make the minimum payment, a lot of that money is only going to interest and your principal is only going to trickle down over time. But the problem that I had was that I didn't focus on increasing my income first. If you make more money, you'll have an easier time paying for expenses. With a higher income, you should have more breathing room to pay for things like your housing, transportation, food, and even just entertainment without going deeper into debt by having to use credit that you don't have the money to pay for. And of course, making more money will help you to pay off debt. With more income, you can set aside more money to make those extra payments so you actually start bringing down your principal amount and not just be paying everything to interest every month. So if you're paying off your debt now, keep going at the pace that you're going, but focus on ways to increase your income so you can speed up the process of paying off your debt. The next one is your age should dictate how much you invest into bonds versus stocks. Now, bonds are a type of investment to where you're essentially lending your money to some type of entity, where that be the government or some other company, and they will pay you for lending them that money. Now, bonds are considered a pretty safe investment compared to something like stocks because they're much less volatile, especially government bonds. But we know that when it comes to investing, less risk means the less potential for gains. And this is why this 100 bond allocation strategy is super outdated. It recommends that you take your age and you subtract it from 100. Whatever this number that you're left with is the percentage that you should invest into bonds. This is a strategy to where as you're getting older, you start to invest more and more into bonds to protect the gains that you've made in your earlier years. And that's a great strategy, but the problem is the calculation. Since the rule says to subtract your age from 100, it leaves you with a very conservative approach to investing. The theory behind this is that younger people have more opportunity to recover from any market downturns, and as you get older, you want to be as safe as possible. But even though bonds are considered safe investments, there are some risks associated with this strategy, and the first is interest rates. When interest rates rise, bonds typically fall in price, which can mean some losses for people that invest into bonds. Now, I know you've been hearing more and more about how we have all these interest rate hikes because of the inflation that we have right now. So even bonds can carry more risk than people think at times. Then you have the inflation risk. Now, bonds offer fixed income streams, which means that inflation can lower the value of bonds over time. If inflation rises faster than the amount of money that you're making on your bonds, then you will lose money. Then you have individual goals. With this 100 rule, this is a blanket statement for everybody. Everyone has a different risk tolerance, different resources, and a different time horizon. But the biggest problem with this is the reduced potential for gains. The longer you're in retirement, the more money that you're gonna need. This means that if you're super conservative and you get towards retirement and you're gonna need more money, you can't go back in time and start allocating more money to stocks. You have to deal with the money that you have and figure it out from there. So after doing some research, I think the more updated approach, the more modern approach to this allocation is instead of using 100 to use something like 110 to maybe 120 and subtract your age from that number. And since I like more risk, I choose 120. So let's say if you're 35 years old and you subtract your age from 120, that means that you'll have 85% in stocks and 15% in bonds, which is a lot more attractive and gives you a lot more opportunity for making money compared to a 65% in stocks and 35% in bonds. The goal is to always make as much money as you can the younger you are, so when you do start allocating more to bonds, you have a nice nest egg that you're actually trying to protect, and you don't have to stress and worry if you're going to have enough money later on in life. The next one is don't invest until you get completely out of debt. Waiting to invest until you're completely out of debt is a very risky strategy. Most times people don't carry a small amount of debt, and it may take them time and sometimes even years to get out of all of their debt. And this is where the problem is. I'd argue that the most important factor, especially in investing in the stock market, is time, because of compounding interest. Compounding is the process of creating gains on top of reinvested gains. So when you invest money and you make some money, then you reinvest that original amount and the money that you've made together. If you keep investing this way, your money will grow exponentially over time. So let's say you started off with $1,000 and you make an 8% return for the year. Then starting on year 2, you'll be starting at $1,080. And if you continue to do this, you can see how the money can just start to snowball over time. The more time your money has to build, the more money you can potentially make. So if you wait until you're completely out of debt before you invest anything, imagine how much time and opportunity you're losing. Look at this chart and you can tell the difference in just how much time means, and it's not always about how much you invest into the market. Obviously, the more that you invest, the more opportunity that you have to grow a bigger account. But even investing smaller amounts of money, you can still grow bigger accounts because of this time and compounding. You can see in this example that Susan, she invested $5,000 each year for 10 years. So in total, she invested about $50,000. So by her starting at 25 and Bill starting at 35, Susan still ends up with more money than Bill, even though she invested $100,000 less than he did. So I'd say that yes, getting out of debt is very important, but try to invest something into the market consistently. Even if it's not a large amount of money, we just want to get into the consistent habit to start building up that compounding interest over time. The next is buying a house is a great investment for everybody. The American dream of owning a home is deeply rooted in our culture, and the dream of home ownership goes all the way back to the 19th century with the Homestead Act, since it encouraged settlers to build homes and farm the land. Now the American dream of owning a home is associated with the idea of family, a married couple living with their kids, white picket fence, friendly dog, and a sprinkler system with a timer on it. But there's a problem with some of this. Everybody is not in the situation to buy a home. Buying a home requires a lot of money up front. You have your down payment, you have inspection fees, you have closing costs, and even more expenses that a lot of people are not even aware of. And these payments can end up being a much larger amount than people budget for. Then you have ongoing expenses like mortgage payments, property taxes, and I promise these property taxes go up so much each year, it seems like there's no limit to it. You have insurance, utilities, repairs, and other maintenance. But the biggest thing is that a home can be probably the most illiquid asset that you have. If I have money invested into my brokerage account and I need to take that money out, I can execute that trade today and that money clears in 3 days and it'll be into my checking account. I cannot do that with a home. And there are times where you don't always make money on homes. Buying a home isn't a guaranteed profit like it's been taught to us since we were young. Just like anything else, it comes down to timing. And if you buy a home at the wrong time, you can have negative equity for quite a long period of time before you can even think about selling. But if you're patient, if you're buying a home because it means more to you than just an investment and you actually have the money to pay for the home and to pay for the ongoing expenses, then obviously it's a great purchase to make, but it's not for everybody. The next one is don't be a job hopper. When I first changed my career into software, my dad was so proud of me. He was so happy that I was into another career, something that I could make more money and potentially have a much brighter future. So after I had worked at my first job for 3 to 4 years, I told him that I was leaving for another job because I was getting a raise in a much better position. And he was happy for me. But then once I got that second job and I told him I was leaving after a couple of years to go to another job, he started to get kind of concerned. He didn't understand why I was changing jobs frequently, because during his time, companies really took care of their employees. They had pensions, they had much more generous benefits packages, they were taken care of. So it made sense for someone to stay at a particular job for 20 to 30 years. But these days, not so much. Now, job hopping is when you change jobs every few years and sometimes even sooner, rather than staying with one employer for an extended amount of time. I always knew about job hopping, but I was even surprised when I got into the tech field that I would see people stay at a company for a year and move on to something else and continue to move on after another year. Now, the upside of job hopping is it gives you more experiences, it helps you to advance quicker in your career, but the biggest is you make more money. The average salary increase for job hoppers can get to 10% and sometimes even higher depending on the position in the industry. By moving from one job to another, you have the opportunity to negotiate a higher salary, negotiate better benefits packages. Now, I won't make it sound like job hopping is all positive, because there are some cons, especially depending on your personality. You may feel a lack of stability since you're changing frequently. You get to know a certain group and a certain team, and then you move to another company and you have to do it all over again, which is something that I've had to deal with before. So you might not build as many long-term contacts from your coworkers that you can use in the future. Now, depending on the frequency of the job hopping, it can raise red flags to other employers as you start to apply and interview. But as we've seen over the last few years with layoffs and hiring freezes, we have to take care of ourselves first and not rely on some executives to do it for us. So that's what I have in this video. If you like the video, please like the video, subscribe to the channel for more content like this.